Will it or will it not? I mean, will the Bank of Canada reduce the prime lending rate on June the 4th? Let's discuss. Well, as the Bank of Canada prepared for its interest rate decision on June 4, 2025, market participants are closely watching for a potential 25 basis points cut. Recent economic indicators present a mixed picture. While headline inflation eased to 1.7% in April, the overall situation is a little complicated. The labor market showed signs of weakness, with April's unemployment rate climbing to 6.9%, the highest since January 2017, outside the pandemic period. Trade tensions, particularly with the US, have further clouded the economic outlook. Bank of Canada Governor Tiff Macklem has warned that unresolved tariff issues could dampen second quarter growth. Despite stronger than expected retail sales in March, which saw a 0.8% increase, the central bank remains cautious. Market expectations for a June rate cut have fluctuated now, with current odds around 32%. Well, analysts suggest that unless upcoming data such as the Q1 GDP figures due on May 30th indicate a significant economic slowdown, the Bank of Canada may opt to hold rates steady to monitor inflation trends further. Now, friends, before we move further, you all know that the moment we reach 2,000 subscribers, your name will go in a draw if you are subscribed, and one winner gets $250 Costco gift card. And also, when we reach 10,000 subscribers, we have another draw, and again, if you are subscribed, one winner gets $2,000 cash, which could go towards your mortgage payment or rent payment. Both these promotions are published on our website. Just by subscribing, you get your name in the draw. And friends, since you are watching my videos in thousands and thousands, just hitting the subscribe button and make you win. The names of the winners will be declared on this channel. Wishing you all the best for the same. And now coming back again to today's topic. On April 16, 2025, the Bank of Canada held its policy rate rope steady at 2.75%. It was the first non-cut since June 2024. Now, in the economic tug-of-war between inflation and economic weakening due to the US trade war, the Bank of Canada is trying to avoid rope burn. There's strain and struggle hanging on until the way to win becomes clear. The anticipation surrounding the Bank of Canada's decision on the prime lending rate on June the 4th has heightened, with economists, businesses, and consumers keenly watching. Should the bank decide to maintain the current rate, several significant implications could unfold, impacting various sectors of the Canadian economy. And the number one point I want to discuss today is economic growth and consumer spending. Now, one of the immediate consequences of not reducing the prime lending rate would be the continued pressure on consumer spending. The prime lending rate directly influences the interest rate on consumer loans, including mortgages, car loans, and credit cards. Higher borrowing costs can dampen consumer enthusiasm to spend on big ticket items. With consumer spending constituting a substantial part of the GDP, any decrease in consumer expenditure could slow down the already slow economic growth of the country. The Canadian housing market, friends, particularly in major urban centers, has been a critical driver of the economy. High prime lending rates translate into higher mortgage rates, making home ownership more and more expensive. Potential home buyers may delay purchasing decisions, leading to a slowdown in housing demand. This could, in turn, result in a cooling of the housing market, which is already limping because of the extremely high rate of interest, although it has gone down by 2.25% since they started going down last year. Now, for current homeowners with variable rate mortgages, the financial burden could increase, leading to higher monthly payments and potentially reducing disposable income for other expenditures. Here, I want to reiterate that the real estate market in Canada is not moving. The money market is tight. Forget cheap money, even expensive money is not available to a majority of customers. People are not qualifying for mortgages and the appraisal values are coming in very low to worsen the situation. Now, businesses are also feeling the ripple effects of the prime lending rate. High rates mean increased borrowing costs for businesses seeking to finance expansion projects or manage operational costs. While small and medium-sized enterprises, SMEs, which rely heavily on bank loans, might find it challenging to invest in growth or hire additional staff. Consequently, this could hinder job creation and innovation within the economy. Friends, if you're liking this video, please smash the like button, friends. You will never miss any of my very informative videos, and it will also allow the YouTube algorithm to show this video to other consumers and customers like yourself. Coming to the topic of inflation and monetary policy. Now, we all know that inflation control remains one of the primary objectives of maintaining higher interest rates. If the prime lending rate is not reduced, it might indicate that the Bank of Canada is focusing on keeping inflation within target levels. However, this approach could be a double-edged sword. While it may prevent the economy from overheating and control price increases, it could also suppress economic activity, leading to lower growth. Well, as of today, we stand at an inflation of 1.7%, which is very, very reasonable, and it has come back from 8.1% in February 2022 to the current level of 1.7% in April 2025. Now, also a steady prime lending rate can affect the Canadian dollar's value on international stage. Higher interest rates often attract foreign investors seeking better returns on their investments, leading to an appreciation of Canadian dollar. While a stronger currency makes imports cheaper, benefiting consumers and businesses that rely on imported goods, it can also make Canadian exports more expensive on the global market. Now, this might hurt export-driven sectors which are vital for Canada's trade balance and overall economic health. The decision to maintain the prime lending rate could influence consumer and investor confidence as well. If the public perceives that the Bank of Canada is cautious about lowering rates due to underlying economic risks, it might lead to a more conservative financial behavior amongst consumers and investors. Now, this cautious approach can reduce speculative bubbles and promote a long-term financial stability, but may also result in slower economic growth. Now, the Bank of Canada's decision to maintain the prime lending rate on June the 4th will have broad and multifaceted implications. While aiming to control inflation and ensure financial stability, the move could slow economic growth, impact consumer spending, and temper the housing market. Businesses might face higher borrowing costs, potentially stifling expansion and innovation. Now, additionally, the decision could influence the Canadian dollar's value and the country's trade dynamics. Balancing these outcomes will be crucial for policymakers as they navigate the complex economic landscape in the very coming months. And a very important question now is that, does Canada risk recession if the prime lending rate is not reduced on June the 4th? Well, I think it does. The decision to maintain the prime lending rate in June carries significant implications for Canada's economic trajectory. While it is not a certainty that Canada will enter a recession if the rate is not reduced, several factors increase the risk of an economic downturn. So, in conclusion, we can say that while maintaining the prime lending rate in June does not guarantee a recession in Canada, it certainly raises the risk. The potential for reduced consumer spending, a cooling housing market, decreased business investment, and negative impact on exports all contribute to the risk. The Bank of Canada now faces a delicate balancing act, controlling inflation while supporting growth. Should the economic indicators continue to weaken, the likelihood of a recession increases, making the case for a potential rate reduction more compelling in the near future. So, in my opinion, yes, the country needs a rate cut, a big rate cut. It will give a positive signal to the people who are looking to buy. Millions of people are not qualifying for a mortgage because of high interest rates and are forced to go for second mortgages at a much higher rates and costs. People are behind and delinquent on their mortgages, property tax bills, and credit card payments as well. As a result, there is a negative sentiment in the country right now, and the whole economic condition is causing concerns. The appraisals are coming in extremely low. Canada has not seen these times in the last few decades, with the exception of something which happened in 2008. But there is positivity in many economists who suggest that Feds are going to take this plunge. Hopefully. Let's wait and see what the Feds decide. Friends, should you have any questions about this, please feel free to call me back. Always remember one thing: if you need financial help today, you need it today. Postponing decisions can put further pressure on your current economic scenario, and it will be harder to come out of this thing if you go more deep in debt. So friends, thank you for watching this video in full. Stay safe, be blessed, and see you soon in the next video with another topic.